Good morning, everyone, and happy Monday. I want to thank everybody for joining our webinar today. Hope everyone had a happy Thanksgiving, and hope you didn't put on about the 5 to 7 pounds I did over the weekend. But glad you guys can make it to the webinar this first work day after the holiday weekend. So today we have with us Doug Murphy, who is the Vice President of National Accounts with Baltimore Life. And what we're going to be talking about is single premium life and the opportunities that are available for your clients with single premium life. Before we get started, as always, would like to kind of touch on some things that we here at Insurance Agency Marketing Services provides for our advisors. First thing, I'm sure you guys have heard about our new producers builders. This is an attempt to help you grow your business. So based on your production level, whether it's 100,000, 250, 500, 750, or 1 million, there are different perks that are available to you, if you will. If you have any questions in regards to our new producers builders, how you're a part of that, what's available to you, I strongly suggest you give us a call. Any one of the sales directors can go through that in more detail with you. Next, we also have the Iams Business Builders, which is our referral bonus to our advisors, meaning that if you refer another advisor, another agent to Iams, and they were to get appointed with any one of the carriers that we work with, we do provide you, the referring agent or advisor, a $50 referral bonus. In addition to that, any subsequent business that they write, there are spiffs for you as well. So you'd like to get details on our business builders, please don't hesitate to give us a call. We also offer you back office support. We always like to say we want you to work smarter, not harder. So the tools that we provide for you, whether it's business building tools and resources or paperless contracting, it is there to help alleviate a lot of the day-to-day mundane work you as the advisor will need to do. We want to work with you all the way from submissions to commissions. So that back office support is available to you. We also have a 24/7 website, which has excellent sales tools. If you're a life producing agent, you might know that we do have a term and guaranteed universal life quote engine on our website. You can access forms. If you're looking for any long-term care information, our LTC grid is on there, as well as our annuity grid, along with current annuity news. And you have the ability to actually submit e-applications from our website. There's a couple of platforms that we utilize for electronic applications. One is iGo eApp Solutions, which you can access through our website. The other is Firelight. Firelight, you can get registered for that platform. And as you see here, these are the carriers that are on Firelight. The majority of the carriers are annuity carriers. We do have a couple of life companies that allow you to do applications via Firelight. The rest of the life carriers that do electronic applications actually goes through iGo eApp Solutions. If you'd like to get more information on that, whether you want to get registered for Firelight or you need assistance with doing an application, whether it's on Firelight or iGo eApp Solutions, please do not hesitate to give us a call. Would more than love to walk you through that process. We also offer creative marketing solutions for our agents, whether it's turnkey agency or digital solutions. So if you're looking for professionally written handouts, flyers, business cards, or stationery, or you're looking to get in the digital marketing space, whether it be email marketing, personal website, or social media consulting, we can assist you with that. I would strongly encourage you to reach out to your sales director, and what we like to do is marketing analysis, which is about 20 or 30-minute conversation of your business, what it looks like now, what your goals are. We can provide you with some ideas, suggestions, if you will, on where we can help you with that. So if you're interested in getting a marketing analysis done, definitely give us a call. Be more than happy to have that conversation with you. We also provide the retirement analyzer, for advisors. It is free for qualifying agents. As you see here, it can help you answer questions from your clients from can I continue my present standard of living into my retirement years, all the way up to how would it affect my family if I were to enter a nursing facility or die prematurely. If you'd like to see a tutorial on that, be more than happy to help you with that. If you have additional questions, again, feel free to give us a call. We also have the Iams Wealth Management team. So if you have clients that have a higher net worth, I suggest reaching out to Charles Jr. and his team. They've done an excellent job in helping advisors increase their revenue, improve client retention, as well as strengthen relationships with their clients. Our wealth management team is doing an amazing job of generating additional revenue for advisors. So definitely reach out to them if you have some interest there. We also have the Life and Annuity Academy. We just had one a couple of months ago, and it was very successful. We worked with Athene on that one. I know that we're going to be doing another one here in the spring. It is a 2-day training, which includes things here like sales ideas and strategies from top producers, wealth transfer tools, advanced annuity sales topics. We also talk about life sales topics, sales ideas, sales strategies. If you have an interest in the Life and Annuity Academy, definitely reach out to your sales director. It is something that we pay for the advisors. So we pay for the travel, the lodging, and the food. Definitely, if you're looking to take your business to the next level, this is something I would say that you need to consider. And lastly, before we get started with the webinar, is we do have our Top Producer Summit that's coming up in 2022. As you see listed here, these are all the areas that we're going. This is a cruise. 4.5 million points are needed to qualify. The qualification period's listed here. We have several agents that have already qualified for the trip. If you would like to know where you're at in terms of qualifying for the trip, we can definitely answer those questions for you. If you have more specific questions in regards to what's needed, definitely reach out to us and we can answer that as well. And with that, Doug, I am going to make you the presenter.
Thanks, Tony. Can you hear me now, Tony?
Yep, I can hear you.
Yep. Awesome. Thanks, guys. Thank you very much. And I'll reiterate what Tony just said. I hope everyone had a great Thanksgiving holiday. And it's kind of one of those things where it's the Monday after Thanksgiving. You guys are probably still a little stuffed from food and kind of getting over the, if you did any shopping or had to do any shopping over the weekend, you're probably, this is hopefully that you'll take some of this to heart. You know, over the next, nothing maybe today, but over the next month or so, this is going to be impactful for you. As I talk today, one, I want to first of all say, you know, thanks to Iams, Insurance Agents Marketing, Tony in particular, and Steve Murray for allowing me to participate in this and present to you guys. It's a great honor. You guys, if you didn't notice from the last several slides that Tony just presented there, this is a fantastic organization. At Baltimore Life, I get the choice of, you know, we don't paper the world with contracts. We don't give contracts out to many organizations, IMOs, independent marketing organizations, but the few that we do, we know one of the things we look for is the value not only that they provide to us, but the value they provide back to their producers. And obviously you can see from those screens that Iams provides a ton of value back to you guys. And it's a honor to be a part and work with such a great organization as Insurance Agency Marketing. So I did want to get that out of the way and say that. One of the things I want to try to do today in the next several minutes is to talk about single premium life. And Baltimore Life has 2 products that fit that market. But I'm not really going to talk so much about the product, because my thought is that if you're interested in the concept and you understand where to find clients, then you're gonna go out and find those clients. The people at Iams or people within our agent service center can help you get more product information. But there's no sense teaching you about a product and getting into the nuts and bolts of a product on an hour-long training call as opposed to letting you know over the, as you're dealing with your annuity clients, your other types of clients over the next month or so, how to identify and say, and to say, is this potentially a single premium life client as well, or would this client be better suited in a single premium life client? And I look at single premium life as kind of a companion product to an annuity sale. You're looking for people that have money that they're not using to live off of right now. They've got excess funds that they want to set aside, perhaps to leave to their heirs, a church or a charity or something else. So it's a similar client, but we're not trying to go in and take the annuity production, annuity sales that's out there, the client's annuity money, if it's not appropriate. And I think the most appropriate thing, and you'll see with our products, is this is money that if the client's needing this money they think to live off of in the future, these products are not the place to put it. Iams has some great annuity carriers and annuity products that's probably a better fit for that. These products are designed specifically for clients that have excess funds sitting aside, whether they're pre-tax or never been taxed, or money that's already been taxed. So we've got products that fit both of those scenarios. But it's money set aside that clients don't intend to have to use to live off of. So I do want to get that out of the way as we go forward. And again, we're going to talk primarily about sales ideas, where to find clients and that kind of thing. I'm going to touch a little bit on the various products and specifics about the products, but it's going to be more focused around sales ideas, I hope. So with that said, the first thing I want to look at is what's important to the client. Client is wanting to live comfortably in retirement. This is, we're looking at a client that's a middle income type of client. This is not wealth transfer or asset transfer for the astute or the wealthy. This is asset transfer for the middle market. All of these products that I'm going to talk about are simplified issue products. They go up to a certain amount, and we're going to simplify issue that with primarily just a phone call of underwriting. On the phone call, they're going to verify medical information off the app, and then we're going to order an MIB and an RX check, and that's all really the underwriting that we're going to do. So with that said, we're going to limit the amount of death benefit a client can get, and I'll talk about that a little bit as well. But this client's wanting to live comfortably in retirement, not have huge excesses of money, but just live comfortably. Maintaining good health is important to them. Happiness and welfare of their children and grandchildren, and leaving assets to their heirs. One of the things that we find from this client, this is not a client that's buying stuff through an advisor or some type of IAR or something like that. They're needing help with understanding their needs, helping them arrive at a solution, and then trying to find. I put down here a client that understand a solution within 5 minutes. And really, what I'm trying to point out there is that it can't be some type of solution that's convoluted or difficult for that client to understand. This has got to be a solution that's fairly simple. And the client says, "Hey, I've got money out there. I'm going to use it in case I have needed an emergency, but primarily it's going to be set out there for my kids or my grandkids or a church or charity, something to use in the future if I die before I need that." So that's what we really see as important to the client. The sources of funds, and there's always ways of looking at this. And again, with the product, I'm going to try to make the presentation as simple as I can as well too. Most of these clients in this middle market are looking at sources of funds. They see their retirement planning process breaking down into three types of funds. And I use mason jars here as kind of an example. The first one is a retirement fund. Second one is a contingency fund, and the third is a legacy fund, what they're going to leave behind to their heirs. And I know this can be done through trusts, but most of your middle market clients, they don't want to undergo that effort, and they don't want to necessarily give up a lot of control of their assets. So, I realize that there's different ways of solving this. These three buckets that the client may look at that. And when I look at that retirement fund, contingency fund, and legacy fund, a lot of times your client probably doesn't even realize that they're doing that. But in their mind, they say, okay, I've got that money to live off of. I've got this money set aside in the event that I have to have it for a new roof or a new vehicle, or something happens to me medically. And then the legacy funds are what's left over that they can leave to their heirs. So they may not have a written plan or a plan laid out, but in their mind, that's kind of how we see that they do that. And a lot of these ideas are backed up by LIMRA, the Life Insurance Marketing Research Association, that we get this from. I've just tried to take these concepts and break it down into a presentation format. I look at retirement funds, and retirement funds include, what a client can expect to get from Social Security benefits. It's their pension plan benefits, and what I'm talking about there is defined benefit pension plans. Obviously, those aren't very popular now. Very few companies provide defined benefit pension plans, but back, you're talking to clients that are, in a lot of cases, 65, 70 years of age or older. A lot of these clients had pension plans, defined benefit pension plans, for years, until the companies they worked for at the time decided to stop doing those. And then you have the distribution from 401k, IRAs, etc. And according to the 2017 American College Study, people between the ages of 65 and 70, this goes back to the idea we just talked about defined benefit. Those people between 65 and 70, 75% of those people had a defined benefit pension plan. So keep that in mind as we go through the next couple of screens. That's going to come back to be important. We're not just talking about money in people's IRAs or money in people's 401ks. We're also talking about defined benefit pensions. So 75% of those people have a defined benefit pension plan. This is interesting. Again, this goes back, the most recent that I can get there is 2012. It's hard to get this data on an annual basis, but retiring baby boomers, and I don't think this has changed too much, but anyway, I want to point out there, retiring baby boomers have a median savings of $147,000 in all household retirement accounts. Now, you can kind of go out and Google that and verify that. If it's gone up any, it's not gone up a lot, but still, that number doesn't seem like a lot. And that's actually up, if you can see there, from 2012, it's up from $99,000. So in 2000, I did this presentation. I put this presentation together in 2019. So 2012, it was 99,000 average household retirement accounts. In 2012, it was 99,000. 2019, it was 147,000. So up considerably, but still not a lot. You're thinking, okay, why would we be talking about having excess funds to live off of when a client only has that kind of money saved to live the rest of their life off of? 22% of baby boomers, these are people that are currently working, but they're considered baby boomers, have less than $55,000 saved. So what I'm trying to do is paint a picture that not everybody has money set aside in their 401ks or IRAs and that kind of thing. And when you look here, it says, however, only 51% of that 22%, only half of that 22% are very concerned about outliving their savings and investment, savings and investments for retirement. And you think, wow, how could that be that, in the whole scheme of things, let's say 11% of baby boomers are only very concerned about outliving their savings when the average there is 55%, they only have $55,000 set aside in savings. And I think it goes back to what I was saying, I'll go back to the previous slide, what I was saying before about the vast majority of people, 75%, had defined benefit pensions. And I use my dad and my parents as an example. My dad had a defined benefit pension plan that he has an IRA and it was a 401k, wrote it an IRA that he has that money out there that he's never used. He's living, a lot of these people of this age or clients of this age live fairly, they're not living the high life. They're living to where they feel comfortable in retirement, going back to the first slide I showed you. And they're living off of their Social Security benefits in a lot of cases. And if so, very little of their retirement income benefits outside of their Social Security. So a lot of these people that are this age, that's why the 22% of baby boomers and the 51% of that are only very concerned about outliving their savings. They're looking at their Social Security and feeling comfortable living off that. So they do have a fair amount that they say, okay, I don't necessarily need that to live comfortably. I'd like to have it available in case I need it in an emergency, and we're going to try to show you ways of doing that. So as they're thinking about retirement, that's some of the numbers that they're looking at. When you go to contingency funds, and this is assets your clients don't expect to use, they're not looking at it to say my house will need a new roof, or I'm going to have my kids move back in with me and I'm going to have some of those funds. They're saying this money's set aside in the event that I need it, but I'm really wanting to look at it more as not planning to live off of it. I just want to leave it to my heirs. This is money set aside, contingency funds set aside for unexpected financial crisis or medical need. maybe your retirement is underperforming, your retirement funds are underperforming, or in some cases outliving those retirement funds. And again, we all know that life insurance can be an opportunity, especially cash value type of life insurance can be a great opportunity for your client to increase the value of that fund. And we're going to try to address that as well too in the products that we're going to show you, and how to make sure that these contingency funds are still available for the client as they go forward. And in the third bucket that we talked about, there was the legacy funds. And the legacy funds really are the insurance funds, what's left over to make sure that we leave as much assets as we possibly can to their heirs. Heirs being friends, their family, loved ones, or in some cases a church or a charity. So if you think about the contingency fund, the legacy funds there, what we're trying to do is to make sure that client, through the annuity purchases that they may buy through you and through Iams, and then the contingency funds and money they've got set aside for their heirs, that kind of liquid funds that they've got set aside that they can set aside for their financial crises and medical needs that they may have and that kind of thing. And then what's left over to provide as big of a bucket of money that they can leave to their children, grandchildren, that kind of thing as possible. So that's what we're trying to look at. We have two products that we market that address all of those needs, I think. And I'm going to go through these a fairly high level overview. The people at Iams can have access to, this is a one-page flyer that we can get out. If they don't have it, I can get it to them and they can get it out to you. But to me, it's a one-page kind of a comparison page of the two different products and where they fit and where they don't fit, respectively. Both of these are on a whole life chassis product. They're not index products of any sort. We have them on a whole life chassis, so everything inside the products are guaranteed. But they're designed to provide money for contingency purposes and obviously to maximize death benefit. When you think of single premium whole life, the single premium whole life is designed, it's a generic type of product. You're going to take a lump sum of money. You're going to say, let's say $50,000 they've got set aside in a CD or something, money that's already been taxed. This is primarily designed for that after-tax money in the CD, money market, 1035 exchanges, something like that, from older insurance policies. So money that's already been taxed, you're going to lump sum that over into and make one single premium payment into a guaranteed death benefit, where the cash value on that then starts to go up from there. What we're trying to do with our product feature is to maximize as much death benefit as we possibly can. So it's single premium whole life. It is designed for after-tax money. Issue ages are 50 to 85. And again, you don't have to write all this down. I can get this, if Iams don't have it, and I think they probably do. If they don't, I can get this flyer out to them and they can get it out to you. But the issue ages on it's 50 to 85. Underwriting classes on this, we have obviously tobacco and non-tobacco. Level 1, which is going to be an underwriting table from standard to table 4. We're going to issue as a standard table. We're going to also look and say, we recognize that a lot of the clients in this age group are going to have some comorbidities. So if you get a client that goes from table 5 to table 8 on an underwriting to where they've got, let's say some heart disease and cancer or something else that's kind of comorbidities, and they fall into that level 2, what we're going to do is obviously we'll use the same premium. So let's say that level 1, $25,000 premium bought $45,000 of death benefit for someone, and I don't have a illustrator up in front of me to tell you what age that would be, but let's just use that as an example. And let's say that client doesn't qualify for standard, but at level 2, the same $25,000 may buy $42,000 of death benefit instead of the 45. So all we're doing is reducing the death benefit. The premium obviously would stay the same. So we do have 2 underwriting classes for the SPWL. Point of sale underwriting, obviously we have that. All you're going to do is when you're with the client, you're going to be able to get on the phone. It's about a 9 to 10 minute phone call with the client. The more you do it, the less time it takes. So we have some agents who do it in 7 or 8 minutes. Some will take 12, 13 minutes. But all we're going to do is verify on that call the underwriting questions on the application. We're going to order an MIB and a prescription drug check in the background. Again, however long that takes to do that, again, on the average is about 9 minutes. we're going to give you a point of sale decision right there. So, you know, I spent 16 years as an agent in the field, so I recognize that what we don't want to do is for you to have an annuity client or a client out there that's got a large sum of money that they're wanting to utilize, and you've got a sales opportunity and you're positioning Baltimore Life there. I don't want you losing that sales opportunity. We want to give you as much of an opportunity to know before you leave that client's house if that's going to be an underwriting, it's going to be underwritten already and you don't have to worry about it any further, or you might want to change your mind and go someplace else based off of the underwriting. So right now, my legal and compliance will let me say over 90%. Right now, we're about 92% plus of a point of sale decision of approved. So we're approving 92% of those point of sale underwriting decisions right now before you ever get off the phone. That means as soon as that call's over with, you can know that that client is going to be approved for that product when you submit the application. We don't do any underwriting with that once we get it in-house. The minimum premium on this particular product is $5,000, so they got to have at least $5,000 out there to as a minimum premium. It does offer partial withdrawal options. In year 2, you can get 10% out. Year 3, 20, so on and so forth. To year 6 plus, you can get up to 100% of the available cash value out. It does have loans available at a maximum rate of 8%. Obviously, we put that out there as a maximum rate. I think the current rate right now is 6%. But we have to put from a legal and compliance standpoint, a maximum rate out there of 8. It does offer accelerated death benefit riders, and this is issued in the states that it has approved. And most states have the accelerated death benefit, but you want to check that just to make sure. It's going to offer accelerated on death benefit for terminal illness of 95%, nursing home of 90%, extended care, home health care, adult daycare are all at 80%. And again, this goes back to that client. You know, this has helped to, you know, the cash value part of that, the loan value part of that, the accelerated death benefit part of that, all addresses that contingency fund portion of that need that the client may have. You know, a client may say, well, I need, you know, $10,000 of that $25,000 that I gave you for a roof repair, or, you know, medical need or something else, and they can take a partial withdrawal on that. They can take a loan for that. Let's say they come down with a long-term care need. And again, this is not long-term care coverage on the accelerated death benefit. Don't get me wrong there. It's not long-term care coverage, but they qualify the same way. They can qualify for the accelerated death benefit rider simply from a terminal illness from a doctor stating that they have less than 2 years to live, or for the nursing home, extended home care, extended home health care, adult daycare, all by doctor certification that they can't do 2 of 6 ADLs. And they can get up to 90% or 80% of the face value of the policy. This is not of the amount of money they gave us as the initial premium. This is of the death benefit of the policy. So let's say they gave us $50,000 premium. It bought $100,000 death benefit. For nursing home, they could get $90,000, up to $90,000 in lump sum cash back if they chose, if that was their need, all at one time. Whereas if they only gave us $50,000 in that example, there is a $250 administrative charge. You could also get partial accelerations. You don't have to take the full 95 or 90 or 80%. You can get partial accelerations on that as well. But all that's designed to help to address the contingency needs that the client might have there from either a financial issue or a medical issue of some sort. How we underwrite this, I told you earlier that it was simplified issue. For ages 50 to 80, the lowest age we go on this product is age 50. Up to age 80, we'll go up to net amount at risk, what we call NAR, net amount at risk of $250,000. And for this product, we utilize net amount at risk there as the difference between the premium and the death benefit. So let's say somebody gave us $50,000 in premium. The most we would be able to issue on a simplified issue basis would be $300,000. So that's $250 difference between that and the initial premium. If somebody gave us $400,000, we could issue $650,000 of death benefit. For ages 81 to 85, again on the level 1, the maximum amount of net amount at risk that we're going to have is 150. So give you an idea, you know, somebody gave us 150 and they're 81, 82, 83, 84 years old, something like that. The maximum death benefit would be $300,000. For level 2, again, this is tables 5 through 8. ages 50 to 80, the max net amount at risk there is 200,000, and for the ages 81 to 85, it's 130,000. And then the death benefit is obviously tax-free to the client. It's the full amount of the single premium whole life. Now that face amount never goes up, but the cash value from the time it starts, from time of issue, the initial cash value will continue to go up on a scale that's built into the policy. They'll get a cash value table in there that's guaranteed cash value based off that whole life chassis product. One of the things that we find that's interesting, if you skip over to the right-hand side, is our generation legacy. If you all are writing a lot of annuity premium, have a lot of clients that have annuity premium, this is a product that's saying, how do we transfer money tax efficiently from qualified funds or non-qualified annuities into life insurance? And we've always been told, you know, you can't do that. You can't transfer qualified funds into life insurance. And technically you can't. But this is the most tax efficient way that we could come up with of doing that, is to develop a product called Generation Legacy. And it's designed primarily for annuity funds, qualified funds, non-qualified annuities, it's got money in it that's never been taxed. And the idea is what you're trying to do there is to minimize the amount of tax that they're going to have to pay to move these funds over from the qualified funds that they're not using to live off of into life insurance. The issue ages on this product is 60 to 80. You can see they're a lot different. They're different. They're older than the issue ages for the SPWL. The reason we go as low as the minimum issue age here is 60 is that one of the questions we want to make sure of, if you've got qualified funds and you're going to tell somebody that tell us that you're not going to need these funds to live off of, we feel like age 60 is the proper age to do that. We don't think at age 50 you're really going to know, especially a middle income market, whether you're going to have enough funds to live off of, and we don't want them tied up in life insurance if they may need those at some future date to live off of. So we think age 60 is the proper age to be able to address that, and the client be able to answer that question, with a good understanding of that. Again, this is the same point of sale underwriting. The underwriting on these two products are basically the same. The application is a little bit differently, but not hardly noticeable. So we have a 92% point of sale decision on that as well too. So you could be talking to a client about an annuity rollover, and the client's need is really they want to leave this money for heirs and make sure they got some money left over or some money available for, in case they have a financial need or something else. So that's the type of client that you're looking for here. But again, the 92% point of sale decision, we want you to be able to know that before you leave the house. Minimum premium again is $5,000, so no different there. They do have partial withdrawals available from the cash value of the whole life policy. And this is a good time to point out what we're doing here with Generation Legacy. And I'll show you an illustration in a minute. But we're issuing this client, when you issue the Generation Legacy, we're going to issue two products. You're going to deliver a SPIA, single premium immediate annuity product to the client, and you're going to issue either a 10-pay whole life product or a 7-pay whole life product to the client. So if the client's ages 60 to 75, you're going to issue a 10-pay life product. If they're ages 75 to 80, it's going to be a 7-pay life product. That's the only way that the difference would be there would be the client's age at the time of issue. But they're going to be able to get cash value from the whole life product, be able to take partial loans from the whole life product. Loans are going to be available again at a maximum rate of 8%. Again, that current rate I think is 6%. They're going to have accelerated death benefit options as well too. And there's a little difference in this. I can get into the reasons for the differences just briefly, but they're going to have up to 75% available for terminal illness, 50% for nursing home, and 50% for extended care, home health care, adult daycare. The reason the difference there is in the accelerating the death benefit of the single premium whole life. I'll give you an example. On the single premium whole life, once they can take that, it's one product, so they can take 95% of the money we gave them there, 90%, let's say, for nursing home, because we already have that money in house. We already have it into the one product. With the Generation Legacy, again, we issue two products, so a client could theoretically come down with where they can't, with an illness where they can't do 2 of 6 ADLs, and they could say, hey, I'm going to accelerate the death benefit. I'm going to get 50% of that from my nursing home So I'm going to get 50% of the death benefit of that. And then I'm going to surrender the life policy as well too. So in essence there, they might, what I would look at, the best way to describe that would be double dipping, where they can't kind of double dip on the single premium whole life. That's the reason we reduced the accelerating of the death benefit. The benefit works out about the same if they chose to do it that way. But that's the reason, as best I can explain it in such a short amount of time, for the differences there in the way we accelerate the death benefit. The maximum face amount is the single premium, the SPIA single premium is going to purchase up to a maximum death benefit on this product at $450,000. No matter what the net amount at risk is, we're not going to issue any more than $450,000 on the simplified issue basis on this product. So let's say we would work it backwards. Our illustration would say, if you gave us an illustration that says the client's, 70 years old and they got $100,000 single premium, it's probably going to buy about $180,000 death benefit. And again, I don't have an illustrator pulled up in front of me here, but let's say that's it. But let's say a client come to you with $400,000 of premium and they wanted to utilize this concept. The illustration would not allow you to do, it would tell you what the premium is for the maximum of $450,000 of death benefit. It's not going to let you exceed that for this particular product. So it would work it backwards for you and say the maximum that you can do is based on the client's age is 350, whatever it may do. So that's a little bit different in the way we manage the maximum face amount there. The death benefit is going to be the face amount of the whole life policy and the remaining payment in the SPIA. So that's a huge difference. One of the things, and some of our competitors that are out there, and I'm not sure, there may be, and I don't want to say for sure, there may be some one or two that do it this way now, that kind of piggybacked off what we've done, but I'm not familiar with them. The whole life policy, obviously that death benefit is going to be tax-free. And with our competitors, it's going to be tax-free as well too. And their death benefit is no higher than ours. It may not even be as high, but because we break it down into two products, we're also going to pay what remaining payments are left in the SPIA. So if the client dies in year 2, we're going to pay the tax-free death benefit of the whole life policy, and the beneficiary can commute to the SPIA payments, or they can continue to receive that over the next eight years or so, or whatever the remaining SPIA payments are, and have that paid out to them as opposed to what was being paid into the whole life. So that's a big difference in how the death benefit works there. And again, I can get this document, this one-page comparison document, out to Iams, or if they don't have it, they can get it out to you. If they don't have it, I can get it to them. So again, where do you find these types of clients? I want to show you if I can get into my slides here. I was thinking I had a comparison slide of an illustration. I don't have the illustration here, but I can get a copy of an illustration for you. But again, let's say you got I can use an illustration of a $50,000 a lady. Let's say you got a 70-year-old female, which is a typical client you might have, and let's say she's got a $50,000 non-qualified annuity now, that she's got $40,000 of cost basis in it, which means that some time ago she put $40,000 of cash into an annuity. It's now grown $10,000. It's now at $50,000. You go see her this week, and you're looking at a rollover for her or something that's more appropriate for her, and she says, "Well, really, Tony, all I want to do is I want to leave these funds to my heirs, my grandkids or my kids, in the event of my death. But I like having them out there in case I need money, for something that just comes up. I don't want to rely on my kids to borrow money from, and that kind of thing." And you say, "Oh, I remember the Baltimore Life presentation the other day, and this may work." So let's look at taking that $50,000 and using the full $50,000. If we were to take that policy and just cash it in, she's going to have to pay tax on $10,000 plus her other income. What we're trying to do is to minimize the amount of tax she pays on that $10,000. It's based on her other income. She may not pay any income tax at all if her other income is low, but what we're trying to do is minimize that tax on that $10,000 and use the full $50,000 of death benefit of annuity funds to maximize her death benefit. And also it's used a lot. Obviously, the more premium you use, the more income it is for you. So it's a benefit for the client and for you to be able to maximize and use a full annuity benefit. But we're going to take that $50,000. We're going to take that and we're going to take it from the annuity that she's in currently. We're going to 1035 exchange that into our SPIA. So as you know, an annuity to annuity transfer is tax. There's no tax paid on that from one annuity to another. We couldn't do it to life insurance, but we can do it from annuity to annuity. So then we now got the money in the Baltimore Life SPIA portion of our generation legacy. So then we're going to try to liquidate that SPIA over a 10-year period. So over a 10-year period, that $50,000 is going to pay out every year about $5,574 of death benefit. So $5,574 every year is going to be it's going to go like from the Baltimore Life SPIA into the Baltimore Life whole life policy. There's nothing the client has to do to make that happen. It's done as part of the application. And out of that $5,400, it's going to buy, in that example, it's going to buy her a $78,000 tax-free death benefit. And we're going to send her a 1099 every year for a little over $1,000. That's the value of the taxable portion. As you break that and you spread that out over 10 years, that's the taxable portion of that benefit is a little over $1,000 of that, little over $5,500 is going to be taxable. So in this example, what we're doing there, instead of charging that client tax on the $10,000 of gain up front, she's going to pay tax every year. She's going to get a 1099 for, let's say, $1,100. I can't remember the exact amount. So let's just say $1,100. I don't believe in most cases $1,100 is going to move them into a different tax bracket. Based off their other income, $1,100 they may not have to pay any tax on that at all. But again, we're splitting that up and splitting that payment up over a 10-year period and minimizing the amount of tax that client may have to pay. So that's what we're doing. And then keep in mind that in addition to the tax-free death benefit, they're going to get the amount of money that they would get what's left over in the SPIA if they died during that SPIA payout. Obviously, that money would be taxable to the beneficiary, but it's money that they would get, whereas our competitors typically don't. They look at issuing one policy to the client. If you give you $100,000 to start with, they die a year later, they're going to keep that $100,000 and they're just going to pay the death benefit. We pay death benefit on both. So where do you find these clients? And again, we'll open this up. I hope I'll have enough time at the end of this to where we can open it up and I can kind of clarify some of these things for you. But again, I wanted to talk about, now we've talked a little bit about the product. Where do you find these clients? And I think as you're going through as you're talking about your clients and you're looking at your clients every week, every month, as you're going out to visit clients, look for clients that have annuities that's not needed for daily living expenses. And I think, okay, how would you identify that? Let's say they're 65, 70 years of age and you're rolling it from one 5-year annuity to another or 7-year annuity to another. They're telling you that they probably have already retired. They've got funds someplace else they're using to retire off of. And just ask the question, do you have money set aside that you're not using for daily living expenses? Let's talk about that. I've had people tell me that they always want to get a conversation started with the client. You never want to ask yes or no questions because that makes it for a very short conversation in a lot of cases, but ask them if they've got leave behind money. Leave behind money is really just a conversation starter. You know where I'm headed with this because you've listened to me talk already, but a client's really not going to know what that is or think about that. But that's leave behind money, just money that they want to leave behind. It's not money they need to live off of. And it's a good conversation starter. 1035 exchanges of older paid up policies. You'll find a lot of clients out there. And my grandfather was a great example as he died long before I was at Baltimore Life. So there was really no single premium available that I was aware of at the time. But he died with 17 life policies that was in a shoebox, as most of the people around this age might have, had a total death benefit of about $15,000 because a lot of these policies go back and were $250 death benefit, $500 death benefit. I think he got a $1,500 death benefit policy when he got married, but a lot of policies that were 20 pay lives, 10 pay lives that his parents bought on him when he was younger, and that was just all paid up policies out there, had a total death benefit of about $15,000, but a cash value of about $14,000. So if I had been at the time, had access to this product, I could have took his $14,000 if he'd been in good health and probably come close to doubling the death benefit on that, as opposed to just a normal $15,000 death benefit he bought under a bunch of old policies that had using the old 1958 CSO tables and that kind of thing. So this gives you an opportunity to look at clients' other policies, take into account what they've got out there, where they may have money set aside that they don't even realize that they've got money set out there. A third concept I look at here is what I call UL rescue. I started in the insurance business again as an agent, August 27th, 1984. And if any of you were around in 1984, I used to be the youngest person in my office, and now I'm one of the oldest. But in 1984, we sold a lot of UL. And back then, you didn't sell it necessarily for the death benefit. You sold it for the cash value, because back then we were illustrating cash values of anywhere from 12, 13 or higher. Some companies were higher than that. The interest rates that we were paying back then. So they were buying it primarily as a ability to build cash and a subsequent death benefit. But the primary reason was for the cash value buildup. And throughout the 80s, or most of the 80s, we saw the interest rate environment and the tax environment allow us to continue doing that. But towards the end of the 80s, we saw the tax laws change, and we saw the interest rates start to go back down. And a lot of these universal lives clients had out there started to kind of take the slope back down the hill. You had some policies out there with huge amounts of cash value that are now starting to lose cash value. And the client may still be paying premium. And I'll give you an example. And again, the best way to look at this is ask your clients whether you sold them a universal life in the past or not. You may never know, if you didn't sell it, if this client has an old universal life they bought, especially back in the 80s. But it's to ask them, do you have an old universal life? Let me see. They're going to know, because they get an annual statement every year. And that's usually a front and back page of an annual statement. On the front side, it's going to be kind of a welcome letter. On the back page is going to be kind of the last 12 months synopsis of their, the premium they paid, the insurance deduction, the cost of insurance, the expense charges, and that kind of thing. And over to the right-hand side is every month is going to show the account value and the cash value. And if that's staying relatively the same or going up, that's a good thing. If it's going down, you can kind of see what it started the year at a year ago and what it's at now. And you can kind of work backwards to see how much longer that product is going to stay in force before the cash value goes away and the policy will then go away for the client. The client's got a number of choices now. You may have a client out there right now today that had, $50,000, $60,000 of cash value, 15, 20 years ago. They're now down to $10,000 of cash value. They're paying $300 a month that they've been paying since they bought it. And they probably realize, they hate to admit it, but they probably realize what's going on because somebody explained it to them a number of years ago, but they're not in a situation to raise their premium to what it needs to be, because that would probably be a lot of money. It'd probably be, several thousand dollars, maybe several $1,000s a month based off their age. But what you're trying to do is to take the cash value in this concept and roll it out of the universal life into a single premium. You're probably not going to buy the same amount of death benefit that your universal life has. So that's not the idea. What you're trying to do is say, hey, this is something that once you roll that cash value, we're going to get a guaranteed death benefit now forever. And we're going to have a cash value that's guaranteed to start going back up now and not go back down and just build into the policy. So it's really what I refer to as a UL rescue. You might refer to it as something else, but it's designed to keep that client from losing all of their death benefits sometime in the future, and to be able to kind of rescue that money and leave them a death benefit and start to build cash value back up. A burial account, we sell a lot of final expense. Some of you may or may not be in the final expense market. I'll use my parents here as an example. Years ago, my mom, when we first developed these products, especially the SPWL, my mom and dad had two $10,000 CDs for my brother and I to use to bury them off of. They already had their funeral plot laid out there, but they felt like $10,000 and a CD each was enough for them. I was able to take about $6,000 of my mom's CD and buy a $10,000 death benefit that satisfied what she was looking for, and it's freed up $4,000. I took about $7,000 of my dad's, bought a $10,000 death benefit, single premium life for him. I freed up a total of about $7,000 between the two of them, and still left them with $10,000 death benefit, which is what they felt like that they needed. So it's utilizing it and thinking of different ways of clients that you're looking at. Don't be afraid to ask them about the burial accounts and the final expense stuff that they have, whether or not you work in that market or not. Another thing is a client that may be on the fence about buying long-term care insurance. And some of you may sell long-term care insurance, but you realize the cost of that, and not a lot of middle-income clients can afford that, plus the life insurance. So you may have a client that's interested in funding retirement. They may have a concern about leaving money to their heirs. They may have a concern about, they don't want to be a burden to their family if they have a long-term care, and everybody's hearing about the necessity of, how many people percent need long-term care at some point in time in their life. And I think the accelerated death benefit riders and the loan provisions and the withdrawal provisions and things like that are a way of addressing that, to help address and see if this is an appropriate product or these are appropriate products for your client. A final idea there is the reduced 1099 income exposure income to Social Security. We don't get a lot of clients that's used in a business situation to utilize that. We do have a few, but not enough to really say that's where you're going to find a lot of your sales potential. For business owners, it's obviously a way of reducing potential taxes and things like that on corporate retained earnings. It's a way for an employer to finance their obligation under non-deferred compensation, or a vehicle for after-tax employee contributions. And again, we don't see these products sold a lot for business owners, but keep in mind it could be. So if you're talking with business owners out there, it wouldn't be worth, if you got a business owner and you think this might be an option for them, get with the people at Iams, and they can walk you through to see if this is one of the better solutions for these clients. So, I think those are the primary, what I would call, as you're going through your client base and you're talking to clients and you're looking at clients that you're calling on this week and next week and through the rest of the year, end of the year, and starting out, is when you're talking to these clients, at least consider giving them an option between whether or not they roll that annuity from one annuity to the next, or they have a different option that puts it into life insurance and satisfies a need to pass it on to their heirs, type of thing. We do have an agent service center. I'll point out here on our board, an agent service center call center, and that number, I take that number down. They can answer a lot of product information for you. I travel a lot, so I'm hard to reach, but this agent service center can help you with, if you got a question on underwriting or a question on, something that's going on with the product policy that you've got pending or something like that. The best place to start is with our agent service center. They can look a lot of this stuff up and help you out without being transferred between different departments for calls. They can help you with licensing information and that kind of thing. Obviously, your first stop would be to the people there at Iams, but if they need help, they reach out to the service center as well. But it's always available to you as well. It's designed specifically to service our agents. This is not the same people that service our clients and that kind of thing. It's service for the agent. So feel free to contact that number. Tony, I don't know if how much time we've got left here. We've got 7 or 8 minutes, look like on my calendar. But if anybody's got questions, I'm gonna turn my speaker back on mute so you can talk. But if anybody's got any questions, I'll try to answer their questions as best I can. If I can't, I'll get it back to them and answer it after the call. Thank you.
Okay, so let me switch this back over to me. There's my screen there. Okay, so
hey, Tony, let me print something else up. Hey, Tony, can I interject one more time?
Go. Yeah, sure.
One of the things too that we have just recently come out with during COVID. I should have brought this up, and I didn't have it as part of the presentation, and I failed to. But this is something that gives you another option. Think about this: you may have a client out there that's an annuity client that's in bad health and doesn't qualify for life insurance, or you come even close to it. Could even be terminally ill, let's say, but they have money set aside in annuity that they're not using to live off of. We have, as part of our generation legacy, we have an ability. It's called spouse option, and our application now allows the annuitant to be one person. Let's say that I'm the annuitant and I'm in extremely bad health and can't qualify for life insurance, but my wife is in relatively good health. So I could be the annuitant with the annuity money out there. I could be the annuitant on the application. My wife be the applicant on the life portion. And because we file taxes together, that's the reason it works for a spouse situation only right now. We could utilize that concept of where my annuity money is utilized to pay, in this same generation legacy concept, a life policy on my spouse. So think about clients that you're out there that you've talked to in the past or run across that the client is uninsurable, and an opportunity that may provide to you with these uninsurable clients out there that feel like they have never been able to buy life insurance or utilize this concept to pass on more money to an heir. simply by utilizing this same concept. So don't forget about the spouse option with that. And one of the things I'll take too here, and I don't have it, Tony, you guys will help me track this, but for anybody between now, it's on this call out there. I think there's a number of people on this call. Anybody that's on this call from Iams that submits an application to us between now and December 31st, between now and the end of the year, we'll send a check for $500 for every application that you send us. That's a Generation Legacy or an SPWL application. So what we'll do is at the end of that period, at the end of the year, as soon as we start back the first of the year, we'll calculate this and tabulate it up. I'll get the addresses that we should send it to from Iams, and we'll send out checks to you guys for whatever amount of applications you sent, $500 for each. So with that said, Tony, I'll turn it back over to you.
Okay. All right, so I got one question asking if the recording can be sent, and yes, that can, so I'll get that out to you. I got another question that was asked, are marketing mailers available for mass mailing? You want to answer that, Doug?
Yes, we can get, yes, Tony, thanks. Yes, guys, if you have a Baltimore Life ID, or if not, people at Iams can get it, or I can help them get it. But if you have access, if you have an agent number and a login out there to get into our website, we have all kinds of marketing materials for all of our products. That's agent directed, consumer directed. If for some reason that you guys want one that you want, we can even pre-populate agent information into places for contact information back. If for some reason that you guys want something specific, let's say that Iams wanted a marketing piece directly just for their agents, if they wanted to design it, submit it to me, and I can run it through our compliance area very quickly, and we can work around, as long as we use a lot of the same terminology and stuff, we can make it an agent specific marketing piece or an Iams specific marketing piece. But a lot of that stuff is already pre-populated and out there and available now.
Okay. Don't see any other questions, but I do have some polling questions that I want to get out to the advisors here. First one is, if you'd like more information on the topic that we discussed, I am launching that polling question. If you can respond to that, make sure to get additional information out to you. And I'll leave this up for a few more seconds to give everybody enough time to reply. Okay, I'll go ahead and close that one out. The next one is, if you're not appointed with Baltimore Life and would like to get appointed, I have that polling question out. I'll make sure to leave that up here for a little bit. Okay. And lastly, on the polling questions, and this is a really important one. They all are, but this one definitely. If you have any clients that come to mind where you can see this product would fit their need, please respond to that, and we'll make sure to reach out to you and have that conversation. Okay. Leave this up for a few more seconds, then we'll go ahead and close that out. All right. All right, it doesn't look like we have any additional questions. However, if you guys do come up with one after the webinar, you can definitely reach out to any one of us here in the Life Department. As you see, there's my name and email address, Justin Ford and Jess Riley, their email address, as well as you can give us a call on the 800-255-5055 and ask for the Life Department. We'd be more than happy to answer any questions that you have. Doug, any final words?
No, I just want to thank everybody, you, Tony, but the participants as well for taking the time to do this. It's an hour out of your time. I know it's busy during this holiday time as well too, and wish everybody a happy holiday. If I don't get a chance to talk to them. So again, thank you everyone for allowing me to do this.
Doug, and thank you very much. And lastly, for everyone, for this content as well as other content, whether it's life or annuities, please be sure to follow us, like us either on our Facebook page or our LinkedIn page. And with that, I will say the same. I want to thank everyone for attending. Hope everyone has a happy and healthy holiday, and we look forward to speaking with you soon. Thanks, everyone.